Hi there, welcome to kneppyinvests. The end of the trading week is upon us. Only about an hour left in trading. I'm recording this at 3:08 p.m. So 51 minutes left in normal trading, and then the 10-minute closing auction. So if you want to buy some shares, if maybe you're a buy the dip investor, now is the time to think about buying shares. I have a feeling the American markets will be up overnight. No reason behind that. But I think the reasons why we saw the Australian market down today and the American markets also down is because of just simply insane reasons. And I'll talk about that in a second. Other things I am going to talk about in today's video, have a look at a bookmark, have a look at the reason why we're down according to, I think it's bar chart. Have a look at the ASX today. Most sectors and what's the other one? Indices are down today. Have a look at the top 5 announcements. And just like every other Friday, Fridays tend to be quite slow. But I did come up with the top 5 announcements. But I would say that none of these top 5 announcements would have made it into the top 5 any other day this week. Just shows you how weak it was when it comes to announcements. Today, have a look at those 5 companies, no honorable mentions. And then, if I have time, I might have a look at a few charts. Now, let's have a look what happened on the overnight markets, because this is interesting. So the NASDAQ was down 0.44%, the Dow Jones 1.53%, and the S&P down 0.74%. Now, let's have a look at the NASDAQ first. And if you have a look at the one-day candlestick, you can see just by looking at this one day that the NASDAQ opened up fairly high today. In fact, it opened up 1% higher, and then we just saw selling throughout the day, particularly in the afternoon, their time, in the morning our time. If we have a look at the 5-minute chart, you can see, yeah, the NASDAQ opened up pretty high this morning. It was up over 1%, and the selling really intensified in the afternoon, probably just after 3 a.m. local time. There was a little bit of buying in the last hour of trading. So, in fact, the NASDAQ was down by probably not quite 1%, but more like 0.7% at about 5 a.m. Now, what's driven this little bit of negativity in the market? I'll talk about that in a second. Probably the other thing I should point out is that gold and copper both had weak days as well, and they have responded a little bit better. So gold's had 2 negative days in a row, but gold is now in a support zone. So this is nothing to be concerned with, because when anything is in an uptrend, on occasion, it will pull back. It looks like gold may have pulled back to a support zone, short-term moving average channel. If gold fell below about 2,275, that would be a bearish sign, because that was the lowest lows. We don't want to see it fall below the previous low. And copper, I did read a tweet or see a tweet that copper had the worst 2 days in its history for quite a while. I think it was 13 years, something like that. So copper was down a fair bit on Wednesday, 5%. Then yesterday it was down about 1%, and it's rallied 0.3% today. And even taking that into account, the 2 bad days, copper is still in an uptrend. It's just it accelerated the week before these 2 down days. So nothing to be concerned about when it comes to copper or gold. And because we are largely a mining exchange, a mining and financials exchange, when something negative happens to the mining industry, it does affect our stock market. And that's why we've had 2 down days in a row, particularly worse than what's happened on the NASDAQ. Maybe not the Dow Jones, but definitely the NASDAQ. Now on to the reason why the American markets turned a little bit nasty in the afternoon. This is from, got to find it first. This is from bar chart. I've actually applied to bar chart, the premier. Just want to test it out for 30 days, just to see if it's good. So here it is, somewhere down here. On a Thursday, this is weird. This is just insane why the market turned a little bit down. On Thursday, most US stocks slumped because, they were higher at the start of the trading. In the latest example of how good news for the economy can be bad for Wall Street. And to be honest with you, that makes 0 sense. When there's good news in the economy, the Wall Street thinks that's a bad thing. It's not a bad thing. When strong economic reports raise a possibility of interest rates staying painfully high, the weakness was widespread and overshadowed another blowout profit report from market heavyweight Nividia. So as a Nividia shareholder, I'm very happy, up 10%. It's just weird that it's looking pretty good. The economy is looking pretty good in America, but the market doesn't like it. Wall Street hates that. And it's all around their obsession with interest rates. And I've probably said this numerous times. When I bought a house in 2010 or 11, interest rates were at the level they are now. And no one was saying a thing about interest rates. No one cared. The market didn't care. That was normal. Because the central banks around the world gave us a taste of low interest rates, we want that again. But that is not something that is sustainable for the long term. We have to accept that interest rates should be more or greater than what they were for a few years, maybe even like 5 years. Interest rates in some places were below 0%. It's absolutely ridiculous. So what was this good news? That's a good question, whoever asked that. So here we go. One report suggested growth in US business activity is running at its fastest rate in more than 2 years. S&P Global said its preliminary data showed growth improved for businesses, not only in the service sector, but also in hard-hit manufacturing. A separate report showed the US job market remains solid despite high interest rates. Fewer workers applied for unemployment benefits last week than economists expected, an indication that layoffs remain low. And all my eyes are on the unemployment level, because if we see unemployment starting to really climb, will be the negative sign moving forward. Let's not focus too much on interest rates. Let's focus on the economy and unemployment. And wherever interest rates are, we'll be able to handle it. And I'd say also, back in 2010, everyone lived within their means. These days, everyone seems to be living outside their means. And that's why everyone's panicking. Anyway, rant over in regards to that. That's why the market was down. I think the market is just stupid right now and behaving irrationally. But who am I to argue? And let's have a look at Nividia. Let's just have a look at Nividia's chart. Beautiful chart. Up 10%. Now, to be fair, it wasn't quite 10%. It was 9.3%. And it was up more than that during the day. I also saw an interesting Facebook post by someone, and this was an expert, saying they put an order to buy Nividia at $950 and then also put a sell order at $999. Someone hit back at him and said, that's not high enough. Nividia is going to open up higher than $950. And yesterday, Nividia share price closed at, I think it was 945, closed at 949.50. And the person hit back and said, no, look at the share price of Nividia is 949.50. What are you talking about? They just didn't realize, for some reason, that Nividia released the results. Maybe they did, but they didn't realize that the share price would open up significantly on open because of those results. So that person didn't buy any shares in Nividia and didn't sell any shares in Nividia because, in fact, the share price never got any lower than their sell price. It was a weird Facebook post from a professional. I'm not sure if it's professional, but we'll say an expert, not realizing what happens when a company releases their results. Share price doesn't open up where the share price closed the previous day. Hint, hint. Anyway, so that's Nividia. Chart looks pretty good. There's me buying Nividia. And that's probably all I've got for the American markets and Nividia. I'm just going to show you just one tweet. I have enough time today's video. This is from Carl Capelinga. I've actually mentioned how there seems to be a correlation between the trend in the share price and whether or not that company will release a negative or positive announcement. It seems to be highly correlated. When the share price is in an uptrend, there's more likelihood the company will release a positive announcement. If the share price is in a downtrend, there's more likely the company will release a negative announcement. I've seen this time and time again over the past 10 years. I think I've mentioned it briefly. And this is Carl Capelinga sort of going down the same road. These ASX stocks had news today that wasn't well received by investors. Notice anything in common. I'll go through all the charts. Were there signals to exit earlier? In some cases, much earlier. Remember book, I don't know what that is. Police cars, revolving light. There's what you think should happen. Then there's the market going to do. Anyway, let's have a look at these charts. So this one is Australian Clinical Labs. Share price in well-defined downtrend. No reason, unless you're very, very bullish about the long term and you think this company is undervalued. I they didn't release anything overly negative, if I remember correctly. So I think this is one company that may not belong here. But anyway, if you do look at this chart, there's no reason to be trading this at all right now. But the other three, definitely I agree with. Eagers Automotive, share price had moved into a downtrend over a month ago. That was a signal to get out. And then they released that negative update, or where it was, and the share price absolutely plunged. Possibly now is the time to think about Eagers Automotive. Now, this is possibly another one of those companies that could be a good long-term play, but in the short term, definitely the share price is under pressure. And the market was telling us something before they released this announcement. And then Ridley Corporation. Market didn't like their update or their results. Share price had been in a bit of a downtrend before these results. Maybe not a well-defined downtrend, but definitely there was negative sentiment building into this company. And then the company released these results, and the share price took another plunge. And then finally there was Telstra. And this is another case where I saw someone recommend Telstra today because this is a great quality company. I would definitely fight back against that, or hit back, or push back against that. I don't consider Telstra Group a high quality company. Why? Let's have a look at the chart. And this is a telltale sign. Telstra Group. In fact, we'll look at the monthly chart. And what has the share price of this company done over the past? Well, since it listed. What's gone backwards? It's gone backwards. This is not the chart of a high quality company. I don't care if a company is profitable and has a dividend. It doesn't mean it's high quality. A high quality company grows through time. That's what we all should be looking for, a company that grows through time. Telstra is not a high quality company. It's a trading stock. The only reason I would own Telstra is to trade. And at this point in time, the share price of Telstra took a massive dive the other day. Another update, the market didn't like it. I think also sacking 28,000 staff or something ridiculous like that. And the share price in a well-defined downtrend. And before they released this negative news, what was the share price in? A well-defined downtrend. No reason to even think about trading a Telstra Group just by looking at this chart. So I actually do like Carl Cabelingo. I think he's really good. I liked him on Ausbiz The Call, but he's no longer on that show because I think he's with a competitor. That's what I have heard, that he's with a competitor of Ausbiz, and he won't be on that show anymore. But he does his own weekly technical update video released on a Monday, and I think last week was like an hour and a half long. And you do get a lot of insight. Smart man when it comes to technical analysis. Okay, so let's have a look at the ASX today. And we'll start with this. So, not the best of days. It seems like the All Ords and the ASX 200 or the XGO both down by over 1%. So is the All Tech. Results not as bad as what we saw yesterday, and better than the other sectors and indices. So let's have a look at the different sectors and indices. One sector is up, energy. So uranium, oil, maybe. What else is in energy? Oil, uranium, probably something else, which I am totally forgetting about. I'd say most of these, well, a lot of these have energy in the name. So let's have a look at the biggest companies. Woodside, so gas, gas. So we're talking about oil, gas, coal. Yes, totally forgot about coal. And uranium, anything else there? I don't think so. And then companies that are affiliated or associated in that sector, like MMA Offshore, which is like boats. Okay, anyway, so the whole point was energy has had a good day today, and well, innovations up 100%, but share price of 0.2 cents. If you do have a look at the biggest companies, so Woodside up, Santos up, Yanco up, Ampol down. So in fact, 3 of the biggest 4 companies in the energy sector are up today, but most of the others are actually down. There you go. So it's been driven by those bigger companies. And the worst performing sector is discretionary, down at 2.2%. Staples down 1.5%. So discretionary is like retail, people spending not money on stuff they don't really need. That's how I think of discretionary. And staples is things that people do need, like food. Real estate down, financials down, IT down. Gold, not as bad, only down 0.5%. That's good. And every other index is down, probably except for energy. Let's have a look. There's energy only down or only up 0.05%. Now, and emerging companies only down 0.29%. They don't have a list of companies in this. Is a benchmark for Australia's microcap companies. It contains up to 200 companies that ranked between 350 and 600 by float adjusted market. Well, that's interesting. So it's like a small cap, but they just called it emerging companies. Anyway, so let's have a look at the best performing companies today and the worst performing companies. See if some of my companies are on this list. Maybe I've missed a few announcements. Maybe Energetics, which is up 114% on a low base and not much turnover, and the market cap's only 6.9 million. I will open up this company's site just to see if they did release an announcement. Consumer defensive. What's today's date? 24th. Pause in holding, trading halt, and then Midcoin antibody licensing deal. So this is definitely one announcement I missed because they released it after trading began. In fact, they came out of the hold. Yeah, they came out of the hold at 2:15 p.m. So I completely missed this announcement because it was released during the day. More than likely wouldn't get that excited by this sort of announcement. Companies are entitled to 4% royalty on net sales of products developed and sold and 8% royalty on net sub-licensing revenue, but that means absolutely nothing because how much are they going to sell? So they could sell very few and they'll get almost nothing. I've seen this sort of announcement before in a few companies and very little benefit in those deals for the company in the long term, but the market's liked it. Let's have a look at the chart just to see, I'm getting a little bit off topic here, just to see if the chart looks any good. No. Straight away, this is a big no. Even though share price is up 100% today, still a no. Share price still in a downtrend. In fact, if you go back to some other days, share price have rallied quite significantly back in March, back in October, and it was a rally on no strength. So I don't care about that one. Still a fairly small company on the ASX, and I have no idea what they do. Otherwise, Strategic Energy, some pretty good turnover for that company. So I should open this one just to see if this company released an announcement today. More than likely it has. It hasn't. In fact, it released some stuff yesterday and did a capital raising. Raises $2 million for South Cobar Exploration and Anoits, NED. Okay, so let's have a look at the chart for SER, just a quick look at the chart, because I did see it moving upwards quite rapidly, and there we go. So the market did like this announcement yesterday, and today's share price has rallied higher. According to TradingView, up 100%, but according to this one, up only 87.5%. And let's have a look at, what was the ticker code? SER. And 93.8%. And then we have Keypath. Well, Keypath Education International is in my top 5 announcements, so I will discuss that company later. Bertos up only on very little turnover. Adterium, a lot of companies I have heard but don't know what they do. BIM Communications has rallied again. And now let's have a look by market cap. Playside Studios is in my top 5 announcements of the day. Aurelia Metals not. Metavisor no. Wondering why Frontier Digital Ventures is running, but I don't care. I am a shareholder of that company. And as we go down the list, no other companies that made it onto my top 5 announcements. Now let's have a look at the worst performing companies. And I'd say when a company drops 28% on $650 worth of trading, that is definitely a company I am going to go completely past. That's true for Armada Metals. I've never heard of that company. Top Shelf, I have heard. I think that's like wine or something, spirits, drinks, down a lot, but fairly low turnover. Not seeing big turnover here for these companies down a lot. And this is just negative sentiment in the market, just driving the share price of these companies down on low turnover because people are panicking and they're just selling on market. That's what causes the share price to plummet and the market to fall. People just selling on market. In this sort of situation, just be patient. Although some of these companies are probably fairly low quality. In fact, the largest market cap I can see here, and these worst performing companies, is all the way down. Brookman Mining down 12%, $204 million market cap. So very small companies within this list. So let's have a look at the worst performing companies by market. AIC AIC Mines is in my top announcements of the day. In fact, I was thinking about taking a position in that company. E-Road is on the list. They released a good announcement yesterday. And nothing else of excitement here. Nothing. Boring day. Okay, so let's turn our attention to the top 5 announcements of the day. And not much excitement within this list. Let's start with AIC Mines at number 5. They did a capital raising, and the share price is down 9.32%. The capital raising, $57.2 million placement. Let's just open up the equity raising presentation. Now, this capital raising was done at a price of 52 cents, and the low today was 52 cents. And I was thinking maybe I should take a position in this company at 52 cents because I'll show you the chart in a second. Chart does look pretty good for a buy the dip situation for this company. And they've done this placement, so they're going to have plenty of cash on hand. Sorry. So let's have a look at this presentation by if it's going to open up again. It's ComSec, really slow ComSec. I assume, funding development of the Jericho copper mine. Now, there is a possibility, because it's going to take a while for this mine to get into production, there is a possibility that copper could absolutely collapse, particularly if we go into a significant recession. Now, 52 cents, so raising 57.2 million through the placement at 52 cents. That's the price. So not much of a discount to the last closing price and VWAP, like a 10% discount. So the share price is down about 10% today. So they're doing a placement. Are they doing a capital raising for shareholders? I didn't see that. So the share price, at a share price of 59 cents, and it's now lower, so 10% lower than that. That means market cap of this company after the capital raising is $337.8 million. So take 10% off, which means the market cap of this company is about $30 million after this capital raising, plus they have cash. So in a way, the enterprise value of this company is lower after the capital raising, and that's intriguing to me. So enterprise value would probably be around about $230 million after capital raising. Other than that, I don't know much about this Jericho copper project. That's not what interests me about this company. It's copper. Copper is in an uptrend. And then the chart. So let's have a look at this chart. I'm pretty sure I've shown you this chart in the past, but AIC Mines chart looks pretty good. It's turned sharply positive, and even with this little bit of a dip after this capital raising, it's now moving towards a nice little support level, and this could be a buy the dip situation for AIC Mines. But again, the share price of this company will move quite in step, not completely in step, but in step with copper prices. So if copper prices absolutely tank it, AIC Mines share price will absolutely tank it. But if copper prices keep on climbing and climb for a long time, you will see a significant re-rate with this company's valuation. That is AIC Mines. Coming in number 5. Coming in number 4, we have Appen. Appen's share price is up. Yes, up 2.9%. They had their AGM today. Okay, so let's have a look at Appen's. What we have a look at? We'll have a look at I don't care about total addressable market, generative AI. I don't care about that. You may not get any of that market. But let's have a look. This is what I was interested in when it comes to their AGM, because most of the time when a company has an AGM, they will have a trading update. That's why I love November, not quite as much as August or February or January, April, July, October. But it comes in after those because companies, there are a lot of AGMs in November, a few AGMs in October, but a lot of AGMs in November, and you do get a lot of trading updates. So we're in May now. So it's sort of like a reverse. In May, there should be a few AGMs because a lot of companies' financial year ends at the end of the calendar year. That's why Appen has their AGM right now in May. Anyway, trading update. This is all I'm interested in. How is the company performing, and what is their outlook? You can see financial year 24 outlook in the next slide. So revenue, total, they have two here, total excluding Google and Google. So Google revenue is now gone. Total excluding revenue, sort of flat. We'll say it's flat. Maybe a slight rise in the past 2 quarters, or past 2 months, but that does not mean there's a trend. You have to look at the whole picture here, and the trend is, I would say, flat, slightly up, maybe flat to slightly up. Underlying cash EBITDA still negative in April. We want to see that positive like it was back in December. That point in time did look like maybe the company was turning things around. You see, December in revenue was pretty good as well, and was underlying cash flow positive or EBITDA positive. So we want to see this company being underlying cash EBITDA positive, not negative, but possibly things are starting to turn around, but I need confirmation. And financial year 24 outlook. So yeah, nothing in here that would make me run to my computer and buy shares in Appen just yet. The only thing would be if I saw a nice reaction from the market. There hasn't been that reaction. Share price is up a little bit, just a little bit. And to be honest with you, this company has been a day trading stock over the past few months, and the share price, I think, has stabilized. I definitely think the downtrend is coming to an end, but there's still a lot of negative sentiment around this company. And I do think there's a lot of people who think this company is headed for the scrapyard. This company won't make it. And who knows, that could be true, but it might be wrong. So I just want confirmation either way. And today was not that confirmation. I think things are not moving in the wrong direction, but they're not quite moving in the right direction yet. Everything's just moving nicely along in what we thought they might be moving in. So that's Appen coming in at number 4. I was going to say 3. Number 4. 3, we have a company I don't know anything about, a New Zealand-based company, Oceania Healthcare. They release their results. So you will see a lot of companies based in New Zealand release their results. And here it is, investor presentation. Let's open up that. In fact, I've already opened it up here. I have a feeling this is it. Yep, this is it. So Oceania. I think it's called Oceania Healthcare. I have a feeling. Oceania Healthcare. Yep, Oceania Healthcare. They only have operations in New Zealand. Another reason why I've never heard of them. And I just saw this photo and I thought, oh, maybe they're in retirement health, that sort of thing. They build a retirement village, that sort of thing. But maybe not. I don't know. So here we are. 95 independent living units and 87 care suites delivered. So it seems like they are in that area. Now, one thing I did notice about this company was a market was 330 million or something. 391 million. So I always have the markup in the back of my mind. Okay, that's the markup of this company. So $390 million market cap. Company's profit, 70.5 million. That's total comprehensive income, 70.5 million. Doubled from last year. I'm not sure. There's probably something in that to increase it or double it. Underlying EBITDA, 82.6 million. Slightly increased from last year, so 3%. So you can see there's a much bigger increase in income versus underlying EBITDA. So there might be a one-off in income. So I more like to look at underlying EBITDA, 82.6. And I thought this company has a market cap of 390, underlying EBITDA of 82. This company is trading on 4-5 times underlying EBITDA. It's not that expensive. What else do we have here? Total assets, 2.8 billion. Total net assets, I don't have here, I think it was about $1 billion. That did intrigue me. Remember, the market cap of this company is 391 million. Total net assets or equity, $1 billion. So this company was trading significantly under equity or total net assets. I think that's right. Operating cash flow, 85.4 million. So again, fairly similar than underlying EBITDA. I'm not sure about the capital expenditure. I can have a look at that in a second. But again, company, just based off the operating cash flow, you'd say, well, this and market cap of 390, this company is trading on about 4 to 5 times operating cash flow. That is intriguing. What else do we have here? Here we have assets. Oh, yeah, they're just telling us about the transformation or the growth in this company over the past 7 years since they listed on the New Zealand Stock Exchange. When did they list on the ASX? I have no idea. Assets have increased almost threefold, more than threefold, in fact. Oh, about threefold, we'll say. And operating cash flow has doubled, more than doubled. So this company is actually growing based off their assets and operating cash flow. What else do we have here? Just talking about some of the developments, all in New Zealand, by the way. I'm pretty sure they have a map here. Yep, all in New Zealand, so nothing in Australia. So there is that possibility maybe they'd want to expand overseas to Australia. Trading results. I think this is where we have the summary here. Net assets, yeah, $1 billion. Occupancy, 91.1%. So it does look intriguing at this point in time, but not the sort of company I would like to invest in, to be honest with you, unless it was for a trade. Now, I also opened up their financial statements because I just wanted to understand a few things about this company. So profit for the year, so total comprehensive profit was 70.5 million. But if you look at the profit for the year, just above that says 31.5 million. So there was a gain on revaluation of property, plant and equipment of 41.2 million. And that had a significant effect on their profit. So that's why I probably would dismiss that total comprehensive profit, because it was really helped by revaluation of property. Now, if we look at the balance sheet, yeah, $1 million of total equity. Now, one thing you have to understand with this company, they have $640 million of debt, only $7.5 million of cash and cash equivalents. So you could say the enterprise value of this company is not $390 million. It's more like, well, $1 billion, which is close to the total equity. So you do have to look at everything. So a lot of property, plant, and equipment, $770 million there. So a fair bit there. And the last thing I always like to look at is just, a lot of times it's the first thing I look at, is the cash flow statement. So operating cash flow, they were right, 85.4 million. How much did they spend on property, plant, and equipment? $52 million. They did get back $20 million from the proceeds or disposal of capital expenditure stuff. So I'll say 32 million to be fair. So free cash flow positive, about $53 million. They also spent $128 million on payments for investment property and investment property under development. So cash on hand at the end of the year was 7.5 million, which was not much higher than last year. So overall, at one point in time, I did think this company looked attractively valued. Not so sure anymore because they do have a fair bit of debt, which is probably understandable because this is a property company. The property is valued at $1.8 billion. You also have to take that into account, $1.8 billion. Anyway, so that's Oceania Healthcare. So let's have a look at the chart just to see if maybe this could be a nice little trade. Maybe there's positive sentiment in this company. I've never had a look at this chart for this company. And no. In fact, when you look at this chart, it's complete opposite of positive sentiment. It's complete negative sentiment. This share price of this company is in a downtrend. In fact, the share price, even though the share price is right today, share price is quite close to its all-time low. If you have a look at the weekly chart, share price was as high as $1.52 back in 2021. Now it's 54 cents. So share price has almost decreased 67% in the last 3 years. Okay, so let's move on from Oceania Healthcare. Spending a little bit too much time on that. Onto a company I do own, that's Playside Studios. Share price up, was it 6%? Share price now up 8% on announcement. A sort of announcement I don't really care about. I don't care about these sort of announcements. It's, in my opinion, this sort of announcement is irrelevant. And for some reason, it's taken ages. It's not a big announcement, ComSec. It's a small announcement. Jeez. Well, I'm timing it. It's a race here between, let's go to Playside Studios. You just see how bad ComSec is. When I open this up in Market Index, it's open immediately. There's no delay. These probably unopened open. It's ComSec. I'm telling you, it's ComSec. And you can see how, I suppose it is a little bit long, but it's not that huge. Is it open up yet? We'll just wait. Okay, so the title of this announcement that has caused a little bit of excitement in the market is Game of Thrones real-time strategy game in development. I don't care about that. I don't care about what the development. developing. This could be a complete bomb of a game, or it could be significantly successful. I would never buy a company on this type of announcement because we just don't know how successful this game is going to be. Even though it is a sort of a name drop sort of game, because Game of Thrones, maybe a lot of people want to play a Game of Thrones video game, but I have no idea. Anyway, the market has liked it. Market has liked it. So let's have a look at the chart for Playside Studios. Even though I am sort of being a little bit harsh on the announcement itself, overall, when you have a look at the holistic, is that a good word to use? The holisticness, the overall story of Playside Studios, it is positive. And the chart tells us that. Share price is in an uptrend. Now, share price has been going sideways for the last 3 or 4 months. Market cap is 345 million, but the company has been growing significantly. For example, the revenue has grown from $4 million to $38.4 million, and the company is profitable. In the last half year, $36 million of revenue, $9 million profit. If they maintain that, say $18 million of profit in a year, and that's not what you should do. You should not analyze half-year profits because we don't know what's going to happen to this company in the second half. But if you do analyze it, you could take the trailing 12 months, by the way. So trailing 12 months suggests the profit is about 7.5 million. But I don't mind analyzing half-year profit. It's just assuming and sort of a what if. So if their profit was the same as this half year, this company would have a P ratio of, say, 20. For a growth company like this, that's okay. And really good volume. You can see the massive increase in volume from February. Not quite coinciding with their share price moving up or moving into an uptrend, but we have seen more of an interest in this company over the past 3 or 4 months. That's Playside Studios, a company I've owned for quite a while, by the way. Owned for quite a while, sort of short-term, not a short-term, but sort of a story stock I bought. When I bought it, it was more of a story stock. And because the share price and the business has really taken off, I've maintained a holding. I'm buying less story stocks these days, much less. In fact, I only have 2 right now. Coming in number 1 is Keypath Education. Straight away, this is the sort of company I probably would not be interested in. Whenever a company has the word education in, I more than likely would not be interested. I'm a big believer that education should be free all the way through. Free education. And the reason I say that, it's beneficial for the economy because if you have free education, you will build a smarter workforce and you become more productive and a greater chance of innovation. Now, I believe that would happen if we had free education all the way through. Anyway, that's not the reason why I don't like education companies. I think a lot of education companies are highly dependent on the government or government regulation. Now, this company released half-year results or full-year results today. So I did not know the other news about this company. And then I saw the share price up 53%. I went, well, the results must be really good. And then I went back and saw the company's being taken over or possibly being taken over. Agreement with Sterling Partners to acquire Keypath shares. Fairness opinion relating to merger consideration. So which one should I open up here? The 152 page. We'll open up the presentation. It doesn't actually say, it says acquire Keypath shares. It doesn't say they're buying them out. And here we go. So the main thing we want to look at here is price. So we already know it's going to be a pretty good price because the share price is up 50%. It's really interesting because it looked like there was another takeover bid for this company based off here. After initial offer of 65 cents per share in February 2023, the special committee analysed options to increase share value and used this to negotiate the price ultimately to 87 cents. That's a 33% increase from the previous offer. And I'm going to have to congratulate the special committee because of what they've done. They have done what they said they were going to do and increase shareholder value. So whoever was on this special committee needs some applauding just because of that. Otherwise, yeah, share price or the takeover bid price is 87 cents. I'm assuming this is a takeover bid offer, so complete takeover bid, and it represents a premium of 88% to Keypath's 6-month VWAP, which is a bit of a manipulation of the statistics, 63% premium to Keypath's closing price of 53.5 cents. That's a bigger number, 63% premium to the last closing price. Cash, 100% cash consideration provides Keypath's unaffiliated stockholders with certainty of value and the opportunity to realize their investment in full cash of this company. So I'm assuming this is a complete takeover. It says merger, which says to me not a complete takeover. But anyway, I don't really care about the company, but this is pretty good news for the company. And to be honest with you, there's no reason to even think about buying this company now. It's under a takeover bid, and if I was a shareholder, I'd be selling right now. And there's a chart. Now, the chart actually does look interesting. I don't have to tell you that much. Well-defined downtrend. So when I said shareholders might be happy, but there might be some shareholders not so happy, and those shareholders would be those who bought back in 2021 at $4. Someone did buy shares in this company at $4. Now the share price is 82.5, and they would not be happy. And they should not be happy at themselves, because why would you be holding this company when you have a chart like this? I have learned that lesson as well over the past few years. No reason to be holding a company when a chart looks like this. You could be hoping for a turnaround. That turnaround never came until about now. Share price now is starting to move up. And in fact, this is the time to be buying this company because chart starts to look good. It's starting to look good. Other than that, I don't know nothing about this company. Market cap 115 million and our revenue of 184 million. Nice increase in revenue over the past 4 years, but the company has not been profitable in the last 4 years. Has the company been cash flow positive? Operating, investing, and financing cash flow negative last year, and operating, investing, cash flow negative in 2022. They were financing positive in 2021, but that was probably a loan or something, or not a loan, what do you call it, a capital raising. And they have not been operating cash flow positive the last 4 years. So that's another reason why I have no interest in this company. And after today, no interest moving any forward. But if I was a shareholder of this company, I would be taking the opportunity to take my profits and find another opportunity. Do I have time for charts? No, I'm not. So I'm not going to show you any charts. I'm going to do my own chart looking later in the next, from about 4:31 p.m. I'll start looking at some charts, have a look at all my tech holdings just to see which companies have done well today. In fact, there's more green in these companies than I expected. That's good. So some companies in my tech portfolio or my trading portfolio have done well today, including Shape. So there's me buying Shape at $1.86. They gave the shareholders dividend in February. Share price plunged. It wasn't February. They went ex-dividend in February. Share price plunged. And those are kicking themselves right now, whoever sold, because the share price has gone up. And someone actually did ask me about this. Why am I trading this if this company is illiquidly traded? I will trade illiquidly traded companies, but I have a very long leash when I decide to sell. I have had a much shorter leash on other companies, but I want to extend that leash moving forward because I've made some mistakes, including Vulcan. I'm hoping Vulcan is up today. Maybe not up, but yeah, about 5.30. That's okay. I have bought back into Vulcan at a lower price than I sold. So at least I bought in a lower price. And I just wanted to give this company a bit of a wider berth or a longer leash. I really had a tight leash on this company, and that was a mistake, I think. I think there is possibility the share price will run from here. And another company that I wish I should have had a much longer leash was A2 Milk. So I just saw the share price dip back here, and my stop loss was way too high. There was a poster very correct with that. My stop loss should have been down here. In fact, it should have been down there. And look at the chart. Chart is beautiful. A2 Milk's chart is beautiful. And I bought back in A2 Milk as well. Okay, so that's all I've got for today's video. If you have any questions, any thoughts, leave them in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.